Hello everybody. So welcome to the 21,000 subscribers Q&A. I am very grateful to all of you who decided to subscribe to my channel. And these questions come from Patreon. I did a few of those in the past. We'll see if I do them more regularly or not. But I just selected questions at random. And so first question is about my investing buckets. As you know, on the channel, I talk a lot about growth, cheap growth, or hyper growth as I call it, but cheap. Some people call it growth at a reasonable price, but growth at a reasonable price is not growing as fast as the type of stocks I follow. I want to follow, stocks that really grow like 30% a year. Revenue growth is really my minimum in general for covering a stock. And that bucket number one is these stocks that grow very fast, but that are also super cheap. So they both need to grow very fast and they need to be super cheap. And this is where I use enterprise value over gross profit over revenue growth. That's my metric here. I modified slightly the PEG ratio using gross profit and revenue growth. Revenue growth and gross profit being correlated, of course, in general, right? If a company is optimized for gross profit. I found that this metric works best for me. And that's kind of how I select whether I find a stock cheap or not. In this bucket number one, the cheap hyper growth bucket, multiple expansion is always a possibility and always a part of a return, and often, not always, often a part of a return, and sometimes a reason as to why I buy a stock that is cheap and then I stop adding because there's been multiple expansion and it doesn't look as cheap anymore. And so that's my bucket number one. This bucket is a fiat derivative. You are still a fiat derivative. You're taking in dollars and you're trying to outpace monetary inflation. Now, my bucket number two, which I talk a lot on the channel, I talk a lot about that, is my debasement plays, my pure debasement plays. And of course, strategy is the big stock that I discuss, but I've discussed many other stocks like Metaplanet, like Cooler. And so these are Bitcoin treasury companies, right? BTCTCs. They follow the playbook of MSTR. These are pure debasement plays. I don't expect any revenue growth from these companies. I just expect them to own Bitcoin, to own the hardest asset, and to increase how much Bitcoin they own over time. Miners that hodl also fit in that category. Even though miners generate revenue, I don't really care about revenue growth. I care about the growth of the stack, the growth of the hodl stack. This is why I'm critical of miners like Iron, for example, who do not hodl the bag. And then the last bucket is the highest quality growth bucket. And so in this bucket, I buy high growth companies regardless of their valuation, or rather should I say I buy the highest quality companies regardless of their valuation. The best fit in this would be a Tesla, a Palantir, a Robinhood. Google, I own Google. I refer to it as kind of my savings account, but it is also a growth company. And so in this case, I absolutely don't look at valuation. I only look at the quality of the business. And sure enough, that has worked for stocks like Palantir or Robinhood. Tesla, not as much. We'll see. My guess is that it's going to work really well for Tesla. Multiple compression, when you buy these high quality companies, multiple compression may limit your return. But the theory behind owning these stocks, these best stocks, no matter what the cost is, the theory is that you can have a stock trade at a high multiple, at a high premium for 20 years. For example, Amazon, traded expensively all the way to 100x your money. Like it was expensive the whole way up, and you have stocks that are just going to be expensive the whole way up, and this bucket is useful for that. Now, about your question, can I cover those regularly, semi-regularly? The answer to that is yes. Yes, I will start talking a little bit more about those. Robinhood I've covered before. Palantir, I need to do another deep dive on Palantir. Tesla, of course, I need to cover it, but it has to be a good day for me, because whenever you cover Tesla, you get a lot of dislikes, you get a lot of hate, and this channel is a hobby for me. So, but yes, I will consider covering it. If anything, it could be private. If I feel like there's too many haters on the Elon derangement syndrome and all of that. If I feel like there's too much disliking, I'll do it private. Anyways, moving on. Question number 2. So this is just a random question about one stock, but I think it's instructive to look at this stock. So Sanara Meditech, SMTI, ticker symbol SMTI. Thank you for suggesting it. I have added it to the spreadsheet, and yeah, it's pretty good, right? SMTI, okay, EV over GP over RG is a 0.13. Doesn't achieve a rule of 40, so that's not as good. But this stock looks pretty good. It's not profitable yet, but it will be, so you can expect a bump when it moves into positive EBITDA margin territory. But I'm a tough grader, and why would I not be interested in that? Well, because the revenue growth is 25%, and this is in a sector that has very, very, very cheap valuations. So the way I assess whether I do further deep dive on a stock, if I'm gonna research it much more, is it has to be hyper growth, and it has to be the cheapest hyper growth, one of the cheapest hyper growth stocks. So for example, if I were to compare SMTI to stocks that I've covered multiple times on the channel, like Delcaf, like CorMedix, you can see CorMedix grows at 180% forward growth predicted, 96% gross margin, 41% EBITDA margin, and it's trading at a 0.03, and it has a rule of 40 of 2 to 1. If I look at Delcaf, you see predicted to grow 120%, gross margin 86%, EBITDA margin 40%, and it's trading at a 0.04. And even if I were to look at companies trading roughly around a 0.14, you have TARS here, which is well, they're losing a lot of money, so this is not a good example. So this is not a bad stock. It's just that there's a lot of stocks that are even cheaper right now. You see, like this one, for example, Regal is even cheaper. Harrow, I need to cover Harrow. This one is very interesting in eye care. You can see there's a lot of there's probably half a dozen stocks in the pharma space that are more attractively priced than SMTI, and therefore it's pretty good. It looks good compared to a lot of other stock on the spreadsheet, but compared to the sector, I find more compelling in the sector on the numbers alone, and so I have to look at the numbers alone before I go judge at the quality. So it's a hold for me. It's not a stock that I would research for now unless it got way cheaper or the revenue growth would increase by a lot. And of course, if this stock was growing at 180%, it would show an EV over GP over RG that would be much lower, right? So that's also an aspect of that. But eventually, good stocks get noticed and make it to the spreadsheet, and eventually I notice them and I buy them. So if it keeps getting cheaper, maybe I'll cover it at some point. Moving on to a question, of course, of MSTR. So this subscriber is thinking about putting 25% of their MSTR stack into potentially a preferred share, and the question is, which is the best? For lowest volatility is what they say, right? But that's assuming you're going to have a bear market. So I'm just going to answer which is the best, right? And conserving the upside. And to me the best preferred, this is just for me, this is not for anyone else, but to me the best preferred is Strike, STRK. That's the best preferred as far as I'm concerned, because you still get a very similar yield to the rest of the preferred, 7.3%. Like, that's not going to make much of a difference when you have our preferred trading at 9%, yielding 9%, 7.3%. That's still very much good enough. And why do I like it a lot? Well, I like it a lot because eventually 10 shares of Strike will convert into 1 share of MSTR. So what that means is that you will be capturing the upside of MSTR above $1,000 a share after, and it will be very interesting to see how these shares trade after MSTR hits 1,000 a share. I would assume they would trade at 1/10 of an MSTR share plus a premium for the yield. And is it going to be a small premium for the yield, or is it going to be a big premium for the yield? Well, that's the question right there. But it's going to make some very interesting curves as to how Strike is going to trade when MSTR exceeds $1,000. Another point of consideration, more in the near term, as far as the value of a stock like Strike, which is worth $109, is what will happen when they drop the rates, and when the Fed eventually drops the rates. rate, of course, a ticker symbol like STRK should, in theory, go up because the yield is now lower. The yield demanded by the market is now lower, and so stocks that yield a lot typically see a rise in their price in order for them to yield less and be more in line with the Fed's fund rate. Of course, this is very theoretical. One last thing I'll say, if you're considering actually selling MSTR to buy a preferred, it's important to look at tax and consider tax. And I don't know when you bought it. It depends when you bought MSTR, right? But on this channel, a lot of us bought MSTR very early on, and so for us, when you're in the 20x territory gains, I know for me, I'm never selling MSTR, and so the big question is the tax question. If you have to sell your MSTR, if I had to sell it, I would not. I would not sell it. This is a long-term hold for me, and I'm very happy about that. Anyways, moving on to another question. So this time, and it's related to MSTR, right? Because I'm saying I'm never selling an MSTR, and you'll see this idea. So this question is about, what if I find a stock not compelling anymore because it's either stagnant or it grew too much? So what am I going to do if I don't like a stock anymore? Will I sell? Will I rebalance? So if I'm down, or if I have barely any gain on a stock and this stock is dead money, or is less compelling for whatever reason, I will sell that stock. I have done that with Enphase recently, for example, right? If I'm way up on the stock, though, I typically see myself as stuck with the stock. This is what a lot of people call the tin can strategy, where you just leave a stock alone and you just let it ride for the longest time. So I will see myself as stuck with the stock if selling it means a hefty tax bill. And so, and of course, I will take the tax bill if there is an actual red flag, if I see an actual red flag. But if the stock is just stagnating and the management is so-so, it's not great, but it's not bad, and, the stock is at 10x and I'm sitting on a 10x, I'm just going to keep the stock. I am not going to take profits and then have to pay taxes. And this all depends on your tax situation, right? But because don't forget that stock being way up unlocks so much margin for you that you can use that margin to make money in different ways via, I don't know, buying other stocks or writing puts, whatever. That margin is very valuable. So you're still able to earn a return on the money generated by that stock. So I have a few stocks in that situation for me where I can't sell. I'm stuck with them now. That would be Palantir. That would be Robinhood. They're both sitting at more than a 10x for me. I could not sell those. Of course, similar with HIMS, I could not sell HIMS even if I wanted to, but I don't want to sell HIMS. I find HIMS still extremely compelling and nearly a buy at near $50. I find HIMS nearly a buy. But Palantir and Hood, obviously at these levels, I don't find them a buy. They are too expensive in my view. But keeping in mind with what I said in the first slide, right? The stock can stay expensive for 20 years. It can do 100x and be expensive the whole way to 100x. So that's the aspect for me. Sometimes, selling tax is painful, especially if you're in the 15 and 20% long-term gains, and pay attention to that. In the US, if you do a lot of sales, if you do a lot of profit taking, you could end up in the 20% long-term gains, depending on the size of your portfolio. So also be careful with that. So, and then that becomes even less compelling to sell. Sometimes, and I've done this a few times historically. Sometimes you're tempted to that. Sometimes I'll be like, okay, I will sell a covered call with a strike 15% above spot. So for example, if a stock is running high and it's been running up, and you're like, okay, I would like to sell it, but I don't want to have to pay the taxes, or the taxes annoy me. I'll put a strike like 15% above, and so if it hits the strike and I lose the stock, then I look at me losing the stock as kind of a tax-free operation, because I sold it with a covered call, and that covered call was written 15% above the stock price that was present whenever I made that decision. And so if I lose the stock, then I look at it and I'm like, okay, I lost the stock, but it paid for taxes, right? But generally, I much prefer the buy, borrow, die strategy. When I want to own a stock, I want to own it for a very long run, hopefully forever. And the stocks version, of course, of the buy, borrow, die strategy is simply to have margin. And margin is very valuable. You don't have to be using your margin to buy stock to find it valuable. Margin is an extremely helpful buffer to have in case there's a crash, right? There's a lot of opportunity that is created by having a big bag of margin. You can also, if you write puts, for example, you can also use that margin as your collateral. That margin is going to serve as your collateral to write your puts, and you're not paying interest. It's just collateral. It's in there just in case. Most likely, if you write your options right, the margin's never going to be used, but you're using that collateral to generate a return on money that kind of doesn't exist, but it's just your credit worthiness with the broker. So just because a stock is sitting at all-time high doesn't mean you have to sell it to reap the benefits of that stock trading at all-time high. Sometimes you could just let it sit there, and it unlocks so much margin for you that you can use that margin to do other operations, including buying stocks that you find cheap right now, or writing puts, or buying safety. Having an account with no margin drawn at all times is an enormous margin of safety. So anyways, I look at it this way. Hopefully that's helpful. Okay, moving on to another question. What's the plan with my BTC treasury companies like Metaplanet? Okay, so MSTR, as I said, keeping it forever. Metaplanet, I want to keep it forever too. Frankly, most of the BTC treasury companies that I own, and many of them are in the red right now, by the way, because we kind of had a MNAV summer or something, and some of these stocks were very expensive. So most of them are in the red, but they're not in the red that much. Like if you have a stock that's in the red, say 30% because the MNAV compressed, all it takes is for Bitcoin to go from like 120 to 150 for you to get back to where you were. So eventually Bitcoin is the floor, and we see it with Mara. We see it with Mara. Like today, Mara is trading at 0.96. Like people want to sell off Mara so much. People hate Marathon. They dislike Marathon a lot. But it barely ever trades below like a 0.95. So the 1x MNAV is the floor, and that floor just keeps rising, and so it will lift all boats, even if those boats have lost MNAV, and you also have always the opportunity of MNAV expansion whenever there is hype in the marketplace, and hopefully they're able to sell stock and monetize it. And again, I can do that, right? I can make this decision. Why can I make this decision? Because I didn't buy options on it. Not that you could on foreign stocks like MTPLF or something like that, but because they're not options and they're not bought on margin. So not options, not bought on margin, equity, straight equity, owning it for the long run. All you have to do is wait for Bitcoin to go up. And, my conviction in Bitcoin is second to none. So I have no issues waiting for Bitcoin to go up. Eventually, Bitcoin will lift all of the companies that are being brutalized by the market. All of these treasury companies will be lifted by BTC, at least. No financial advice, but that's my view. You ask also about Ethereum treasury companies. So I have no issues with Ethereum treasury companies. I am not a maxi at all. I have no issues with that. In fact, it'd be interesting to see, because of course oil companies do that, right? Oil sit on proven reserves, and the value of a lot of oil companies is based on their proven reserve. It'd be interesting to see if there's something as a gold treasury company, just a gold miner, for example, who just doesn't sell the gold but sits on the gold. So because I don't have a problem with a company sitting on oil, a company sitting on gold, I don't have a problem with a company sitting on ETH and buying ETH and trying to acquire ETH. I don't follow SBET or BNMR or Game too closely, but I would say this all depends on the MNAV, and you gotta have that sweet spot where they can still, raise money via the ATM, so they can still issue new shares accretively via the ATM. You want that. And you also don't want it to be too expensive, because if it's too expensive, then MNAV compression can hurt you. So I like SBET a little more than BNMR. BNMR, everybody's looking at BNMR right now because of Tom Lee. So I kind of like SBET. It's more in the shadows. I like it a little more. But again, these companies I don't follow too closely. But I probably should. But I'm so MSTR oriented. But Bitcoin, as Bitcoin season matures, which it eventually will, I believe a lot of people will be like, oh, Bitcoin ran too much. Bitcoin's too expensive now, and then alt season should begin. And so what happens is something like this: you have Bitcoin goes up first, and then the money rotates to, say, the second safest. No financial advice, but I know to a maxi that might be scary to hear, but let's assume the second safest is ETH. So the money's going to move from Bitcoin to ETH, and then eventually the money's going to move to riskier stuff, and perhaps Sol is still seen by the market as riskier stuff. And of course, Solana treasury companies I also find compelling. So the one thing that I can say about ETH treasury companies, Solana treasury companies, and now you have Litecoin treasury companies, you have Sui treasury companies. I think you have a Caspa treasury company. I'm not so sure. The only thing that I can say is that to me, Bitcoin treasury companies, I will very confidently keep for the long run. ETH and Sol treasury companies, I can't say that for sure right now. I have to see how it unfolds, and I'm leaning towards a no as well, at least for ETH treasury companies. For Solana treasury companies, maybe, but for now, still leaning towards a no. But Bitcoin treasury companies, yes, they're forever in my portfolio. That's my take. So, okay, thank you for your kind words about the channel. Again, very happy about 21,000. Plus subscribers. So a new question here. This is a question about EOS, and this stock has been trending all over the internet. It's been trending on X and on YouTube, and right now there's lots of hype. And I'm not saying the hype is not warranted. The big beautiful bill appears to be beneficial for them, but you're in a situation where the stock, nearly did a 4x in 1 year, and it's up 2.5 times in a matter of a little more than 6 months, I guess, but in very little time. So this stock ran very fast, and so when I see a stock like this, I don't want to chase. So the quick answer to that question is, I feel like I missed it, and I try really hard to not be a psychological creature, but unfortunately sometimes you are, and I feel like I missed it. And the problem is that it's not perfect on everything else. If my psychology was my only problem with EOS, i.e. my feeling that I missed it, I could potentially overcome that. But I think EOS has other things that I don't like. Well, first of all, it's got a little bit of good, like lots of backlog, enormous backlog. Demand is there. But the bad is there's a lot of debt. And I remember when I made this video, I covered it on the channel before. When I made this video, I remember that deal that they got for that debt was not the most compelling deal out there. So a lot of debt. So I don't like that as much. The revenue is very spotty. Of course, it's understandable for battery storage that revenue is spotty. We know that, for example, Tesla Megapacks are spotty. But this is a pure play energy storage business. And so the spotty revenue, I'm afraid of the swings in the stock price. What happens if for some reason one quarter sees a huge drop in revenue recognition, for example. So spotty revenue is not as predictable as fully nicely linear revenue, and as a result of that, these companies technically should be trading at a discount. And that's the problem, this company is absolutely not trading at a discount. Enterprise value over sales is a 74 times. And yes, forward revenue growth is expected to be plus 200%. That's amazing, but to me, it doesn't justify paying 74 times price to sales. I would be very interested if it was trading at like between 5 and 10 times price to sales. And there are stocks like that, plenty that I've covered on the channel, who are showing these revenue growth numbers. I'm thinking about healthcare and biotechs right now, but there's other stocks too that are showing these top line revenue growth numbers, but that are trading between 5 and 10 times price to sales, sometimes even less. And so this one in my view is is too expensive for my blood, and I feel like I missed it. But I wish everybody luck who owns it, and that might be a mistake from me to not buy it. But you have to make choices in your portfolio. When you manage your portfolio, you have to make choices, and sometimes knowing what not to buy is as important as knowing what to buy. All right, now question about real estate. Long time viewer of the channel here, I presume. Notice my perspective change on real estate. Because was it a year and a half ago? Yeah, I sold a rental property. I was like, I'm done, no more rentals ever, and now I just own my own house. And I don't want to own it anymore, but I'm being a little greedy, and I'm waiting for the rates to drop. But I don't want to own my house anymore, or at least I prefer renting or buying a very small house with a big lot, a large piece of land and a small house, and maybe my Texas flair is shining through here. I don't know. Maybe it's a Texas thing, but I have reasons. I have reasons as to why I think it's a better way to do it. But anyways, let's talk about real estate. So in the early days of the channel, I thought the Fed was bluffing. I thought the rates would not stay this high this long. Very few people thought the rates would stay this high this long. I now believe, and I've believed that for about a year now, that the rates have become political. It's a political decision more than anything. The CPI, the inflation, all of that sort of stuff to me is showing that we should drop the rates, but they're not doing it because of political reasons, in my view. So as a result of that, mortgages are too high, and we are now in a situation that even if the rate cycle begun, it would still take years for mortgages to get back to what they were, and for the demand in real estate to pick up to levels that I would find very compelling. It would still take a very long time, because here's the thing: the Fed cannot drop the rates by 100 basis points if they can't drop the rate by 1% in one time. Otherwise, you could spook the market, and you could create a crash, like a systemic issue in the market. So they have to drop the rate at maybe 0.25 basis points, peppered with a few 50 basis points here and there, but they have to take their sweet time when they cut the rates, right? And that's the problem. That's going to take years for those rates to get back to the level that they used to be right about when I started this channel. So that's point number one. It's going to take a while. And then I mostly view a house as an expense for now. I think this is how a house should always be viewed. But unfortunately, when you're going to spend that kind of money, to justify spending that kind of money, you always in the back of your mind tell yourself, okay, well, maybe it's a little bit of an investment. And I think that's a mistake. Hence why I believe in a small house. I believe in a small house. Because a small house, you're like, okay, it's an expense. Might as well get it as small as you can, because you don't have a choice. You have to buy a house, right? So you need one. You don't have a choice, but you need to not fool yourself, because they are expensive, and this is all based on the size. That's why I say get a small house, because if you look at taxation, insurance, and maintenance, those three things are only gonna go up. And most of those three things are based on the size of your house. Look at your tax bill. You will see that the value of the land is, typically like 1/5 of your typical house. The value of your lot is typically very, very small, and so it's not taxed nearly as much as the actual built square footage. So imagine how much cheaper your taxes would be if you had a 1,000. I don't think they make them this small. But what if you had like a 1,200 square foot house? 1,200 square foot house. That would be heaven from a tax standpoint, and you could make sure that most of the value of the house is actually held in the land. Also, maintaining land is so much cheaper than maintaining a house. A landscaper is not expensive. You know what? They're gonna charge you $10 extra per mow if you have like a really big lot. Maybe $25 extra for mowing the lawn each time. Come on, but like maintaining land is so much cheaper than maintaining a whole house with pipes that can burst and all sorts of issues. And insurance, of course, much of the cost of insurance is about the dwelling, replacement cost of the dwelling. So real estate, you have to have it. You can't do without it. I think renting is very compelling right now, as so many quote unquote luxury apartments are like fighting to rent you a nice spot for cheap. But I see a lot of benefit to owning a house because you can make changes. It's your house. It's the American dream. But my evolution on this is A, see it as an expense. B, small house, large lot. Or small house, but in a medium-sized lot, but in an expensive part of town. To me, that makes a lot more sense. I'll conclude with this on real estate. Cost of roof replacement has been the most shocking thing, and of course, you gotta replace your roof. About every 30 years? I've witnessed the price of roof replacement literally triple in a matter of 5 years. So that costs a fortune. Today, replacing a roof is like 30 grand. Didn't used to be this expensive at all. And anyways, it's just so cost, money down the drain for something where unfortunately you don't have a choice because you need to live somewhere. But small house, large lot, that's the situation where I see it makes sense. And then you had another question about stocks with yield. Well, I don't like that at all. I don't like companies that pay a dividend. I would much rather reinvest the money into the business. If anything, if you don't have anywhere to invest in the business, well, invest it into marketing to sell more stuff, or create price cuts to make your product grow organically faster. Like do something. So I don't like dividends. I think they're an artifact of the past. Of course, they're taxed, so I don't like that at all either. But you didn't mention here what if you can deduct or you're not really taxed on them. So if I needed a dividend for whatever reason, or even for peace of mind, which is fine, then I would look at a stock that is not known as a dividend stock. I would still buy a growth stock, and I would just screen out growth stocks that actually pay dividends. But I would still buy a growth stock. And I found two. United Health, it's not really a growth stock, it's more of a special situation where the stock lost more than 50% of its value in 6 months, and the market is crazy. And so now United Health, which has a low payout ratio, which is not a growth stock, you can get the equivalent of a dividend stock yield at 3.5%. And so I find that quite interesting, quite compelling if you're interested in getting a yield, which I am not. And then there is this stock called Caspi, which I've covered before on the channel. It's not showing here, but Caspi pays like 7 to 8% dividend. The big question for Caspi is, are they going to pay the dividend this year or not? And we don't really know if they're going to do that or not this year because they acquired this business in Turkey that cost them a lot of money. But Caspi historically has paid a dividend in the 7 to 9% because this company is one of the most profitable I know. But again, I own both of these companies. But I bought them not for the dividend. I bought them because I think they're gonna go up, right? I bought them because I think they're growth companies and they're gonna get better. That's why I own them. Alternatively, and it's always important to mention the alternative. Why not just own growth companies and just sell a covered call and do like a 5 delta covered call? Like do a covered call where you have like 98% chance of winning. You could technically do that and achieve, a 5% yield or a 4% yield, but then you take the risk of losing the stock, which is, not really ideal. But that's an alternative that's still, worth mentioning. In my view, I try to not have income. I much prefer growth. Growth gives you the opportunity to see your account grow and to just borrow money against it someday if you ever need it. But if you need that, I would pick a company for growth and just enjoy the dividend as a the cherry on the cake, if you will, but nothing more. All right, and last question: Peter Lynch. Is Peter Lynch my mentor? There's two things I like about Peter Lynch. I like his ratio, the PEG ratio, and of course I've modified it to my own ratio. So the PEG ratio is price to earnings growth, and me, I do EV over GP over RG. So I kind of modified it, and actually in the Peter Lynch ratio, of course, it's a 1. You want to see it under 1. In mine, it's roughly under 0.5. Like if you're under 0.5, it's starting to look cheap. So I think the price to earnings to growth ratio has been pretty revolutionary. And I do my own thing where I prefer EBITDA, of course, because or gross profit even better, because even EBITDA, right? Marketing expense is removed from EBITDA, and I view marketing expense in the 21st century as an investment. I view R&D as an investment. So even EBITDA, we could criticize that. But I think the problem with maximizing earning, and most of the market still judges companies on earnings, but the problem is that when you maximize earnings, you also maximize your taxes, right? And when you maximize EBITDA, the big advantage is that you don't necessarily maximize your taxes because you add the depreciation, you add the amortization, you add that back. And I think it gives a better picture. The other thing that I like about Peter Lynch is that he knew when to stop, and he stopped at the top, and he knew exactly when to retire. And that's something that we'll see if Warren Buffett does that right or not. He's retiring at the end of the year. We'll see. But Peter Lynch was good at knowing when to stop. And regarding your last question, can I say a few sentences in French? Oh my gosh, this is so weird. La réponse c'est oui, je peux, mais je parle plus beaucoup français à part ma famille qui est toujours en France. Et sur la chaîne, on est quoi? On est 2%. On doit être 2%, 1 ou 2% de francophones sur la chaîne. Donc très peu de monde va pouvoir comprendre ce que je dis quand je parle français. Peut-être quelques Canadiens. J'ai quelques Canadiens qui parlent peut-être français, mais c'est à peu près tout. Je ne sais même pas si j'ai un subscriber qui est français ou pas. Donc le français, malheureusement, c'est plus très utile maintenant que j'habite aux États-Unis. All right. But anyways, this was not investment advice, not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.